Money is a concept that has been around for centuries and has evolved significantly over time. In the past, money was often backed by gold or other precious metals, giving it intrinsic value. However, in today's world, most money is created by banks and governments through the process of credit creation. This means that money is no longer tied to physical assets and can be created and circulated at will. While this system of money creation has its advantages, it also has its disadvantages. On one hand, it allows for more flexibility in monetary policy and can help stimulate economic growth. On the other hand, it can also lead to inflation and economic instability if not managed properly. In this video, we will explore how the system of money creation has evolved over time, from its origins in precious metals to the modern system of credit creation. We will also examine the benefits and drawbacks of this system and how it impacts our daily lives. Join me as we dive into the fascinating world of money. Money is an essential part of our lives, and we use it every day to buy goods and services. In the past, money was typically backed by gold or other precious metals, which meant that it had a physical value that was tied to the amount of gold or other precious metal held by the government. This was known as the gold standard. However, over time, the system of money creation has changed. Today, most money is created by banks and governments through the process of credit creation. This means that money is no longer tied to physical assets like gold or silver, and it can be created by banks whenever they want. This system of credit creation has both advantages and disadvantages. One of the benefits is that it allows for more flexibility in monetary policy, which can help stimulate economic growth. For example, if the government wants to increase spending, it can borrow money from banks and inject it into the economy. However, this system of credit creation can also have drawbacks. One of the main concerns is that it can lead to inflation if too much money is created. This is because the more money there is in circulation, the less valuable it becomes. This can lead to rising prices and a decrease in purchasing power. Credit is a financial instrument that allows individuals, businesses, and governments to borrow money for a variety of purposes. Essentially, credit is a promise to repay borrowed funds at a later date, typically with interest. When someone takes out a loan or uses a credit card, they are using credit to access funds that they do not currently have. Credit comes in many forms, including personal loans, mortgages, credit cards, and lines of credit. Each type of credit has its own terms and conditions, including interest rates, repayment schedules, and fees. One of the primary benefits of credit is that it allows individuals and businesses to make purchases or investments that they otherwise would not be able to afford. For example, if someone wants to buy a house but does not have enough cash on hand, they can take out a mortgage and make payments over time. Similarly, a business might take out a loan to invest in new equipment or expand their operations. Another benefit of credit is that it can help build credit history, which is important for future borrowing. When someone uses credit responsibly and makes payments on time, they establish a good credit score, which makes it easier to access credit in the future. However, there are also potential drawbacks to using credit. One of the main concerns is that it can lead to debt if not managed properly. If someone borrows more than they can afford to repay, they may struggle to make payments and incur high interest charges and fees. Credit is an important part of the modern financial system and can be a useful tool for individuals, businesses, and governments. However, it is important to use credit responsibly and carefully consider the terms and conditions before borrowing. Money and credit are closely related in the modern financial system. Credit is essentially a promise to pay back borrowed funds at a later date, with interest. Money, on the other hand, is a medium of exchange that is used to buy goods and services. In many cases, credit is used to access money that individuals or businesses do not currently have. For example, if someone takes out a loan, they are borrowing money that they will pay back with interest over time. This means that the loan creates new money in the form of credit that did not previously exist. Banks play a central role in the relationship between money and credit. Banks are able to create credit through the process of fractional reserve banking, which allows them to lend out more money than they actually have on deposit. When someone takes out a loan, the bank creates new money in the form of credit, which is added to the borrower's account. This new credit can then be used as money to make purchases or pay bills. The relationship between money and credit can have both positive and negative effects on the economy. On the positive side, credit can be used to stimulate economic growth by providing individuals and businesses with access to funds that they would not otherwise have. However, the creation of too much credit can also lead to inflation and economic instability. This is because an increase in the amount of credit in circulation can lead to an increase in demand for goods and services, which can drive up prices. Additionally, if borrowers are unable to repay their loans, it can lead to defaults and financial crises. Overall, the relationship between money and credit is complex and plays a crucial role in the functioning of the modern financial system. It is important to use credit responsibly and carefully manage the amount of credit in circulation to avoid negative consequences for the economy. Money works as a medium of exchange that enables individuals, businesses, and governments to buy goods and services. Money can take many forms, including physical currency, digital currency, and bank deposits. In the past, money was often tied to physical commodities, such as gold, which gave it intrinsic value. However, today, most money is fiat money, which means that it has value simply because the government has declared it to be legal tender. This means that the value of money is largely based on trust and confidence in the government and the financial system. The creation of money and credit is regulated by central banks, such as the Federal Reserve in the United States. Central banks have the power to control the money supply by adjusting interest rates and other monetary policy tools. By increasing or decreasing the supply of money, central banks can influence inflation, economic growth, and other key indicators of the economy. The Federal Reserve System, commonly known as the Fed, is the central banking system of the United States. It was established in 1913 by the Federal Reserve Act, and its primary function is to control monetary policy in order to promote economic stability and growth. The Fed is made up of three key components: the Board of Governors, the Federal Reserve Banks, and the Federal Open Market Committee. The Board of Governors is the central governing body of the Fed, responsible for setting monetary policy and supervising the operations of the Federal Reserve Banks. The Federal Reserve Banks are regional banks located throughout the United States, each of which is responsible for carrying out the monetary policy decisions of the Board of Governors. The FOMC is a committee made up of members of the Board of Governors and Federal Reserve Bank presidents, which meets regularly to discuss and make decisions about monetary policy. One of the key tools used by the Fed to control monetary policy is the manipulation of interest rates. By raising or lowering interest rates, the Fed can influence the amount of money in circulation and the level of economic activity. For example, during times of economic downturn, the Fed may lower interest rates in order to encourage borrowing and stimulate economic growth. Conversely, during times of inflation, the Fed may raise interest rates in order to reduce the amount of money in circulation and control inflation. The Fed also plays a crucial role in regulating the banking industry and promoting financial stability. It supervises and regulates banks to ensure that they are operating safely and soundly. And it provides a wide range of financial services to banks and other institutions to promote the smooth functioning of the financial system. Overall, the Fed is a key player in the global financial system, and its policies and decisions can have significant impacts on the U.S. and global economies. As such, it is closely watched and studied by economists, policymakers, and financial market participants around the world. The Federal Reserve System has several key functions and responsibilities. Here are some of the main things that the Fed does. 1. Conducts monetary policy. The Fed is responsible for conducting monetary policy in order to promote maximum employment, stable prices, and moderate long-term interest rates. The Fed uses a variety of tools, including setting interest rates, controlling the money supply, and using open market operations such as buying and selling government securities to achieve its objectives. 2. Regulates banks. The Fed is responsible for regulating banks and other financial institutions to ensure that they are operating safely and soundly. It supervises and examines banks, enforces laws and regulations, and works to promote the stability of the financial system. 3. Provides financial services. The Fed provides a wide range of financial services to banks and other institutions, including providing loans, managing the payment system, and serving as a lender of last resort. 4. Conducts research and analysis. The Fed conducts economic research and analysis to inform its policy decisions and to better understand trends and developments in the economy. It also publishes a variety of reports and data on economic activity in financial markets. 5. Oversees the payment system. The Fed oversees the payment system, which includes the various mechanisms that are used to transfer money between individuals, businesses, and financial institutions. The Fed works to ensure that the payment system is safe, efficient, and reliable. Overall, the Fed plays a crucial role in the functioning of the U.S. economy and the global financial system. Its policies and decisions can have significant impacts on interest rates, inflation, employment, and the stability of financial markets. As such, it is closely watched and studied by economists, policymakers, and financial market participants around the world. Interest rates are the cost of borrowing money, usually expressed as a percentage of the amount borrowed. In other words, they are the amount of money that a borrower must pay back to a lender in addition to the principal amount borrowed. When you take out a loan or use a credit card, you are typically charged interest on the amount you borrow. The interest rate is determined by a number of factors, including the amount borrowed, the length of the loan, and the creditworthiness of the borrower. In general, interest rates tend to be higher for riskier borrowers and for longer-term loans. Short-term loans or loans to borrowers with strong credit profiles may have lower interest rates. Interest rates also play an important role in monetary policy. Central banks, such as the Federal Reserve in the United States, use interest rates to control the supply of money and influence economic activity. For example, if the economy is experiencing a downturn, the central bank may lower interest rates to encourage borrowing and stimulate economic growth. Conversely, if the economy is overheating and inflation is a concern, the central bank may raise interest rates to cool off the economy and prevent inflation from spiraling out of control. Overall, interest rates are an important factor in the borrowing and lending of money, and they play a crucial role in the functioning of the economy. Inflation and deflation are two concepts related to the overall level of prices in an economy. Inflation occurs when the general price level of goods and services in an economy increases over time. This means that it takes more money to buy the same goods and services than it did in the past. Inflation can be caused by a variety of factors, including an increase in the supply of money, an increase in demand for goods and services, or a decrease in the supply of goods and services. Deflation, on the other hand, occurs when the general price level of goods and services in an economy decreases over time. This means that it takes less money to buy the same goods and services than it did in the past. Deflation can be caused by a decrease in demand for goods and services, an increase in the supply of goods and services, or a decrease in the supply of money. Hyperinflation is a particularly extreme form of inflation where prices rise at an extremely rapid rate, often spiraling out of control. This can occur when a country experiences a significant increase in the supply of money or a collapse in its currency. Hyperinflation can have devastating effects on an economy, leading to a loss of confidence in the currency, a breakdown in economic activity, and social unrest. Governments and central banks around the world closely monitor inflation and deflation, as they can have significant impacts on the economy, including on employment, interest rates, and economic growth. Generally, most economies aim for a stable level of inflation, typically around 2% per year, to promote economic growth and stability. The process of increasing and decreasing interest rates is one of the primary tools used by central banks to control the economy. This is because interest rates have a direct impact on the level of borrowing and lending in an economy, which in turn affects economic activity and the overall level of prices. Let's say that the economy is experiencing a downturn, and there is a lack of demand for goods and services. In this situation, the central bank may decide to lower interest rates to encourage borrowing and spending. Lower interest rates make it cheaper to borrow money, which can incentivize businesses to invest in new projects and consumers to make large purchases, such as buying a home or a car. When businesses invest in new projects, this can lead to job creation, which in turn can stimulate demand for goods and services. When consumers make large purchases, this can also increase demand for goods and services, which can help to stimulate economic growth. As economic activity increases, prices may start to rise, leading to inflation. On the other hand, if the economy is overheating and inflation is a concern, the central bank may decide to raise interest rates. Higher interest rates make it more expensive to borrow money, which can discourage borrowing and spending. This can help to cool off the economy and prevent inflation from spiraling out of control. When borrowing and spending decrease, this can lead to a decrease in economic activity, which can in turn lead to a decrease in prices, known as deflation. This can be problematic if it leads to a cycle of decreasing economic activity and decreasing prices, which can create a feedback loop that can be difficult to break. Overall, the process of increasing and decreasing interest rates is a delicate balancing act that is used to control the economy and maintain price stability. However, it is important to note that there are limits to the effectiveness of this tool, and other factors, such as fiscal policy, also play an important role in shaping the overall health of the economy. In conclusion, we can say that understanding how money works and how central banks, such as the Federal Reserve, use monetary policy tools like interest rates to manage the economy is essential for everyone. The money system, credit, and interest rates all play a crucial role in shaping the economy and our everyday lives. As we have seen, inflation and deflation can have significant impacts on the economy, and central banks use monetary policy tools to try and manage these effects. It is important to remember that monetary policy is just one part of the larger economic system. Fiscal policy, which involves government spending and taxation, also plays a crucial role in shaping the economy. In future videos, we can explore more about monetary policy and its impact on the economy, or we can dive deeper into fiscal policy. Thank you for watching, and please let us know in the comments if you have any questions or suggestions for future videos.